All right, join us now for a one-on-one conversation is Ryan Detrick. He's a CMT and Chief Market Strategist over at Carson Group. Ryan, I appreciate you taking the time. Let me ask you about sort of the broader market and how you're viewing the market today. At this point, year to date, continues to reach new all-time highs. Talk to me about any concerns you have over market consolidation, or Ryan, what do you see when you look at the market that maybe you feel we're not talking enough about?
Yeah, JD, thanks for having me. First time here, honored to be here. There's a lot of questions there. So where do I want to start? Let's start big picture. The time we're recording this is like one of the best starts to year ever for the S&P 500, up about 15%. But we've had 31 all-time highs so far. That's a lot, right? That extrapolates out to 66 all-time highs, which would be darn close to the all-time record set in the mid 90s. But I think what's really interesting for listeners to know is this. Yeah, we're gonna have ups and downs. We're gonna have volatility, but we think we're in a bull market. I mean, and one way to look at it, I took a look. When you have at least 20 all-time highs the first 6 months, JD, like we're going to now, the next 6 months, so let's call it the rest of the year, got the exact number here in front of me. It is up a median of 9.6%. What in the world does that mean? Well, anytime year, the median last 6 months is 5.6%. So that's just one way to look at it. But momentum begets momentum. We've been bullish at the Carson Group since, honestly, the fourth quarter of 22. We moved overweight equities December 22. People hated that call last year. Now I'm seeing a lot more strategists and people are jumping on. But we just don't think this bull market's over. We can get in more of the weeds of it, but we just think this bull market's alive and well. One more thing. It's normal to see a summer rally in an election year. We were on record saying don't sell in May, buy in May. I mean, you tend to get a rally, and boy, oh boy, is that taking place with the 5% rally in May, another 4% give or take here in June. I know June's not over, but we think there still could be a little more summer rally, which would be perfectly consistent with an election year.
We'll get into more on the how equities tend to historically perform during an election year. Right now, as we're having this conversation, we're at 54.80 in the S&P. Ryan, do you have a year-end target for our viewers who just kind of want to get a sense on where you see the market going between now and the end of the year, as we're coming up just about at the halfway point?
Yeah, we came into this year expecting the S&P to gain between 11 and 13%. Now, we're about 15% right now. We have our mid-year outlook, which will release, I think, in exactly 2 weeks. So we're going to update that number, and I can't quite give it away. But when we manage money, we manage billions of dollars for our Carson partners all around the country. And we've been overweight equities, and we still are. Like, if you look at a 60-40 portfolio, I believe we've managed different types of portfolios for different strategies. We're around about 65, 66% equities in those 60-40 portfolios. And we're still there. I mean, we've actually added a little bit of equity risk. A couple months ago, we added a little bit more to industrials and financials. Some of those groups that have, I know they're not tech, I get it. We can get into this. We think we're going to see more broadening out. Some of these other areas are going to take the baton the second half of this year. So we still think stocks are a place to be.
Do you like any of the sense of the rotation that you've seen? Let's go there, what you were just saying. If it's not tech, what are we rotating into that kind of excites you, and anything a little under the radar, I wonder?
Yeah, I mean, I don't know if this is under the radar because it feels like it's out there a lot, but we do have a slight overweight to small caps, and our largest overweight is actually to mid caps. And I get it. Mid caps have done a little better. Small caps are flat on the year. S&P's up 15. We know tech and NASDAQ's up even more. But we look at things like what's going on with the inflation data. And we continue, JD, to see what we think are really big improvements. I mean, we've got negative 4 months in a row of grocery prices negative. We've got 5 months in a row of used car prices negative. You've got the Manheim used car index down 23% from the peak a couple of years ago. There are signs to us under the surface that inflation is drastically improving. And we all know shelter has been this big issue. CPI X shelter, the last 3 months annualized is close to 2%. Core CPI just came in at 1.6%. That's annualized 2%. What I'm getting at, what Carson Group's been saying for a while now, we think inflation is last year's problem. We think inflation is going to really start to improve. Maybe it starts this Friday with the PCE data, and we're starting to see some signs that the Fed can cut. Just because the Fed cuts doesn't mean the economy's going into a recession. We think it's more surgical cuts like we saw in the mid 90s, and honestly in 2019. You can do some cuts and just more that sign that the Fed is no longer hawkish. And what's the Fed say every time they talk? stock. They come off hawkish. Our worry is they're not looking at the data correctly. And I mean, you hope the Fed is, but we think one or two more good inflation prints will make it very clear that September could be the first cut, November could be the next. And that could be kind of the spark that's needed to get more dispersion in different things, specifically small and mid caps. But we also do like I mentioned, industrials, financials as well on kind of that cyclical value side of things.
So since you jumped to inflation, let me go there. I noticed that you put up on Twitter or X the last few days, Ryan, an old quote from Ben Bernanke. You wrote that he once noted back in the day during an FOMC meeting, quote, inflation's a lagging indicator. We cannot wait until inflation is down before we begin to act. Is it your sense that this FOMC today will follow that same course that Ben Bernanke once laid out?
Hope so. Yeah. Hope's not a strategy. Let's be very clear, but we hope so. We'll see more again with the PCE, but we know inflation, again, is running, up around what 3.4, and you look at CPI and PPI, those ballpark around those areas. But again, the core PCE, what the Fed really cares about, that's probably going to come in at 2.6 year over year, and we might see a 0.1 month over month here, which again is showing big improvements. And if we continue to see that, we're optimistic the Fed will realize, listen, it's a Wayne Gretzky quote, right? Skate to where the puck is going to be, not to where the puck is. Inflation's going lower there's disinflation taking place. The Fed doesn't need to wait for 2% inflation before they officially say, oh, you know what, inflation's better, let's start to cut now. And I think that Bernanke quote really sums it up.
And a Wayne Gretzky quote on Game 7 of the Stanley Cup Finals might be a good omen for the Edmonton Oilers. We will see. Let me ask you, of course, about Nvidia. Continues to be the AI darling, up at least 140%, some odd or so here year to date. Do you see the Nvidia hype continuing into the second half of 2024 for everyone who's heard those stories? And hey, maybe even people still have FOMO and wonder if they missed out on the Nvidia train. How do you view that story, Ryan?
So we're more neutral tech in general. Now, Nvidia specifically, what's so unique about it, I mean, yes, it's up like 700% approximately since the start of 23, okay? But if you look at it, like 80% of that is coming from earnings. We've seen earnings up well over 600% on Nvidia. So it's not like, remember back in the late 90s, or you read about it, the forward P multiple of Cisco in the early 2000s was like 200. Okay. Nvidia's is 42, 43 as we sit here. That's a little high, but when you look at the growth, I mean, 26 billion in revenue, right? I mean, look at it, it's justified where it is, we think here. But now here's where things go. Last week, Nvidia was around 140. Its 50-day moving average was about 100. That, keep this plain and simple, that is really, really stretched. And then you had that outside day where last Thursday where, keep getting a little geeky on you here, but the high on Thursday was above the high on Wednesday, but then the low was also lower than on Wednesday where it closed on Thursday. So you engulfed the day before. Keep this simple. The last time we saw that on the video was March 8th. The stock went in a bear market after that, went down 20% over the next 5 or 6 weeks. Now, 20% bear market, those are the definitions we use with the rally Nvidia's had, 20% pullback. It wouldn't even be that abnormal. In fact, it'd be probably perfectly normal. So to us, again, Nvidia, the hype is there. I mean, it was the most valuable company in the world for like a cup of coffee, for a day or two there. Then the sell-off took place, and rightfully so. I mean, the growth it's had is truly amazing. But again, we're more neutral. Or we are. We're neutral technology, large cap tech. Again, price to sales are off the charts. If you look at the market's pricey. Yes. But if you take out communication services and technology, the market's not that pricey at all. In fact, financials and industrials are pretty cheap relative to where they've been the past 20 years. Oh, by the way, small caps relative to large caps are as cheap as they've been since 1999. That kicked off about a 13-year period of outperformance of small caps relative to large. We're not saying that's going to happen again, but what we are thinking is investors need to realize you don't always want to buy the shiny object, okay? Sometimes the thing is a little dirty is actually worth something. And there are some parts of this market that are quite well valued. And again, we think it's cyclical values and small and mid caps is how we're looking at the world here.
I know people on the fundamental side may have some concerns with Nvidia in terms of its own consolidation of a consumer base, the Microsofts, the Metas, all these other companies that are trying to spin off their own AI components, disproportionately contributing to Nvidia's revenue. I wonder, is there anything on the charts that you see, Ryan, that might concern you for an Nvidia, whether it's RSI or some other indicator that you follow that say the chart might tell a bit of a different story that we should be paying more attention to?
Well, I mean, I kind of hinted at already, I guess, just the fact that it was so historically above its 50-day last week. And then you had the start of the reversal last week, and you had that bearish outside day on Thursday. And again, the last time we saw that, it led to a bear market. So that's what gets us. Yes, the RSIs and different levels of overbought, oversold, or about as overbought as you can get. But I'll be honest, a lot of people said that at the start of the year. Then the stock goes on a double, more than doubles once again. But again, it's been justified with those earnings, which is so fascinating. But it is the stock we all talk about, and you look at historically. I believe it's the 12th company, according to S&P, Howard Silverblot over at S&P. So it's the 12th company since 1926 to be the most valuable company in the world. So that by itself is just an amazing feat. But again, we just think that there's probably some better opportunity the second half of this year when you look at sectors and that stock specifically. It just feels a little frothy to us here.
Later on this week, we'll get the first presidential debate, former President Trump, the incumbent Joe Biden. Any other election storylines that you keep in mind that you think investors or our viewers should also keep in mind as we get into the back half of the year that could be pressure on equities or something we're not even necessarily considering, Ryan?
Yeah, good question there. That'll be fun to watch. I think we'll see. We'll just see what happens on Thursday night with that. But the one thing that got us is coming into this year. When you look at election years, when you have a president up for re-election, so a first-term president, the S&P has been higher 10 of the last 10 times, back to like Eisenhower, up 12.2% on average. So it's normal to see strength when the president's up for re-election. It's those lame duck years, 1960, 2000, 2008. And listen, who the president wasn't going to slow down. The financial crisis wasn't going to slow down. The tech bubble burst. But still, it's just things to think about. What gets us, though, of course, is in the White House matters. But it's gridlock is good, is the old saying in Washington, right? The last 13, well, I guess his last 10 years, this is the 13th year, where you had gridlock, where you had one chamber of Congress one way and the other chamber, Senate and House split. Right now, we know it's a very small majority for the Republicans in the House, like 3 or 4, and it's 51-49 for the Democrats in the House, or in the Senate, I'm sorry. But when you have divided Congress last 12 years, the S&P has been higher. This year's probably going to be the 13th year. What I think really matters for investors going forward when you wake up after the election, whoever wins the election, we're pretty optimistic. We're still going to have some darn close gridlock. And we think a lot of way smarter people than me think it's going to flip-flop. Think, the Democrats are going to lose the Senate, but take the House. Republicans are going to lose the House, but take the Senate because of the way the maps work. Again, that's way above my pay grade, but I believe a lot of it. Listen to what a lot of these people say and just listen to what's going on out there. If you have that division, if you have that checks and balances like our forefathers wanted it, you can't have too much spending one way or another. You can't have too much power one way or another. When we heard, red waves and blue waves, you hear all these things. Markets don't really like that, so to speak, because then you can get way extreme. And again, if things come in the way we're anticipating, we'll still have gridlock. That's probably something investors need to pay attention to. That's probably more of a positive than not. Last comment on this, look what's been passed the last couple of years, right? Infrastructure. Well, that makes a lot of sense. The Inflation Reduction Act. There are some parts of that weren't about inflation reduction. We know, but most people still agree that made sense. Oh, how about this? We're not so crazy about China being in charge of all of our chips. We learned that during the lockdowns and the shutdowns when we were opening up in 2021, 2022. China was still on lockdown. We couldn't get our chips that we wanted. So we're bringing those things home, onshoring. Excuse me. Get all choked up talking about onshoring, apparently. But onshoring and bringing these things back, those are things that have been passed by Washington. I think both sides of the aisle agree on, for the most part. And the other thing we all agree on, apparently, on left or right, is being tough on China. So whoever wins the election, we're still going to be pretty tough on China. And I know President Trump obviously has some more aggressive things with tariffs and things he's floated out there. But one of the more fascinating things to me, the 3.5 years, give or take, that President Biden's been in the office, he hasn't taken away one single President Trump tariff. I don't know. I guess a little surprising, but maybe it shouldn't be. But he made it sound like he was going to. But again, being tough on China is one thing we see. Also, defense spending continue to increase. Defense spending, defense production. Look at the industrial production numbers that came out last week, up like 10% year over year. I mean, that's a big jump. There's a lot of spending going on in defense. I don't think whoever wins the White House is going to change that either. Both presidents have shown that they kind of like to spend some money. They don't have a big problem with budget deficits. Those things are probably going to stay as well. So to us, what we're focused on is what's not going to change after the fact of this election. And those are some of those areas we don't think are going to change.
That's a great response. It's great context, and we all get choked up talking about onshoring. Ryan Detrick, CMT and Chief Market Strategist over at Carson Group. Ryan, thanks for taking the time. Good to have you.
Thank you for having me. I appreciate it.